sharing has rose to fame as he predicted or analyzed the fraud at Steinhoff and also in Wirecard. And he's saying that the company's cash that is showing out is missing. He's alleging them of buying companies that were controlled by Grenke executives, saying this is like against governance and could also mean that the company is trying to improve its financial data here. And he is also pointing out a couple of other things linking the company to potential fraud with its leasing business. The report is about 64 pages long, and as usual, it's a little bit hard to put all the bits and pieces together.
Yeah, the effect on the share price, though, clearly devastating. We can see that on our screens. What As in German leasing company Grenke slump after accusations of fraud by short seller Viceroy. The sell-off deepens even as the company strongly rejects the report. Good morning, everybody. Just coming up to the start of the European equity trading session, then let's have a quick look at futures. Futures have been telling us a fairly gloomy story. We've been expecting to see, or we are expecting to see, some weakness at the start of the trading day. Really a lot to do with what the Fed said about the US economy and the pace at which it is recovering or not. That seems to be something that is weighing on market sentiment around risk assets. That was certainly true of the Asian session, and this is how the European equity markets are just opening up or down. So the FTSE 100 down by 0.6%. As I say, Asia was weighed down by this negativity as well, down by 0.9% on the MSCI Asia Pacific. US futures also still point to the downside. We're down by just shy of 2% now on Nasdaq futures, by more than 1.5% on E-mini futures. So we are expecting some negativity as a result of what we heard from the Fed, perhaps. The CAC is now opening in Paris. That's down by 1.4%. We've got the IBEX also down by 1.3%, waiting for the DAX to open up, waiting for some of the big car names to open up as well, actually. And we had the EU car registrations figure, which after a few months of recovery had looked actually quite gloomy around an hour ago when we got that data. So that's of interest. We'll keep an eye on that. Now, European markets then opening to the downside. That's after Fed Chair Jerome Powell highlighted uncertainty around the outlook for the US economy. Let's get into a conversation with our guest this morning. Cole Smead joins us now from Smead Capital Management, where he's president and portfolio manager. Really good to speak to you then, Cole, this morning. In the aftermath of the Fed, how do you make sense of what we're seeing in markets? Does it seem sensible, logical to translate what we heard from the Fed yesterday into such a risk-off picture this morning?
What's going on this morning is I wouldn't take a lot of credence to coming off what the Fed said, just because there's a lot of noise just in markets day to day anyway. I think the Fed really has themselves in the position that they didn't really ever want to be in, which is they have nowhere else to go. They can never really cut again to a certain extent unless they want to experiment with negative rates, which they can. And I say that, Anna, because if you go back 2 years ago, the Fed began their cutting to, in effect, prop up stock markets as the late 18 calendar really hurt U.S. equities. And now we're in a position where, if my gut's right, 2 weeks ago we peaked out the tech phenomenon in the United States, and there will be no Fed support to U.S. equity markets on the short end of the curve.
But there's ongoing support. We didn't hear anything from the Fed that suggested that they're going to dial back their level of support. So is it about what the Fed's doing, or is it the fact that the Fed highlighted once again, and they've done this before, that they need fiscal support here?
Well, correct. They can provide support in terms of buying assets, but on the price of money, they cannot provide any support whatsoever. Other central banks have obviously ran into this problem. And the beautiful part about markets is central banks in the short term can affect markets, but in the long term, they really can't. And I say that because at the top of equity markets, you run out of buyers. And at the bottom, you run out of sellers. And the Fed can't do anything about running out of buyers in call options or stock markets ultimately. Use all the stimulus that the central banks of the world have provided, and that hasn't propped up equity markets there. We've had performance chasing going on in U.S. stock markets, and that's the only reason why things have been so well.
And Cole, what the Fed's low rates are supposed to do, though, is give people confidence to perhaps borrow to invest, and maybe businesses might be thinking more about doing that if they know rates are going to stay low until 2023. Do you see that for the businesses that you hold? Is it significant that they can rely on those low interest rates and therefore borrow to invest?
Yeah, it's a great question. I'll give you the data point that I think actually reflects what's truly going on Main Street USA. Coming out of the lockdown, the two things that shocked watchers in Wall Street was that autos and housing have led the United States out of the lockdowns of March. Now, I say that because that is a classically normal thing to happen coming out of a tough recession. However, coming out of the 08-09 recession, those did not lead, they lagged the entire time. So I say that because the fundamentals of what we're seeing coming out of this problematic era tied to COVID is a classic textbook reversion to the mean in the economy. And so I think that really sets up a picture that's different than what the Fed communicated, which would be that you can see higher rates because of a classical recovery versus having a languishing recovery, a languishing labor market like we had coming out of the last 10 years. So I think this is really different. And the problem is, you look at the rearview mirror, no one's seen something like this, so they really don't know how to react to it, including the Fed to a certain perspective. And that's why people are so spooked of whether inflation will ever come back.
Yeah, and so do you think that the Fed will be caught out with rates too low then, if given what you just said there?
I'm betting my entire net worth that that's probably true, Anna. So I'll give you an example, okay? If you look at the composition of markets and the way that the commodity markets are set up right now, there are incredibly low expectations in the future of the commodity markets. There's been some that have gone off, to huge levels. It would be gold, and then secondly, things like lumber have been hotter than hot recently. You see cargo pricing has been picking up, say from LA to Hong Kong. That's been a big pickup in the last few weeks here. So you see certain pressures out there right now already starting to form, but they're not en masse. And the difference would be if we get input pressures that are really strong, which isn't good for U.S. equity markets and would put pressures on inflation. And the dollar being weak is a very big picture of this. You just go to eras where the dollar weakens, and you're going to find that commodities do really well. And I think that's going to be a story that really creeps up into the Fed's dialogue over the next year or 2 years. But that has very little to do with us topping out our equity markets here, like I said before. I think that game is over. The Fed is going to have to watch it. They won't be able to manipulate it at all.
Cole, thank you very much. Stay with us. Cole Smead, Smead Capital Management President and Portfolio Manager, willing to bet his entire net worth on the Fed being caught out with too low interest rates. We'll get back to that topic of conversation and get more of Cole's strategy in just a moment. Just to some breaking news, though, across the Bloomberg, we've got a red headline that says the ECB will allow temporary relief in banks' leverage ratios. This is coming through in an emailed statement from the ECB. The ECB describes the circumstances at the moment as exceptional, as many have, and says that this justifies leverage ratio relief. So to some extent, a lot has been expected of banks through this crisis. They've been expected to keep lending, to assist governments, to keep the money going to the places where it is requested. And a lot of restrictions have then been put on banks in terms of the amount of dividend they're allowed to pay out and resilience and robustness around the balance sheet. Well, here they're getting a little bit of a break, if you like, allowing temporary relief in banks' leverage ratios. Banks can benefit from leverage ratio relief until June the 22nd. I guess, of next year. That is another line coming through from the ECB then this morning. Coming up on the program, autos, but not Tesla. We take a look at Cole Smead's stock picks and why he's shunning one of this year's stock market darlings. This is Bloomberg. welcome back. This is the European Market Open. European equity markets on the back foot this morning, down by just over 1%. US futures also point to the downside. Let's get back to our conversation with Cole Smead, President and Portfolio Manager at Smead Capital, who's with us. And you talked a moment ago, Cole, about how housing and cars had bounced back really well, and yet you're not buying Tesla. What is it about autos that you do and don't like at the moment? Where do you go for exposure?
Yeah, I mean, you know, we pick U.S. stocks, and the biggest problem is the U.S. Automakers don't do as good a job as other people out in the world. You know, you want to be part of the Porsche holding company, not part of the Ford holding company, historically speaking. So on the housing side, the housing business here has been fabulous, and that's something people didn't expect, as we talked about earlier, coming out of those lockdowns. And the interesting part is because of the labor market's current juxtaposition, where we don't have enough blue-collar trades, or like talking about the commodity markets, for example, inputs are not in a place where you can't grow housing starts in the United States 25% in a year. It's fairly impossible because of the supply constraints, not the demand curve pushing it. So what that means is for home builders in the United States, they're likely to be able to grow their building at 10 or 15% a year, and we'll see that in total U.S. housing starts. The marginal swing producer could be some private builders, but you're not going to get into an environment where these builders are going to be able to get stupid and do anything too dumb in the interim, because it's just going to be too tight on the supply side. So what does that do? It takes a cyclical business like U.S. housing and makes it more consistent, because there's just less room for dumb practices in the market because of supply.
And so what kind of returns would you expect to make on housing, given what you've just said there about how supply will be so important and mean we avoid dumb behavior?
Yeah, no, it's a great question. I mean, I could put up numbers, but I think it would be kind of silly. But let me just give you an example, okay? Let's just say that, let's say a builder like Lennar, who we own, can grow their housing 10%, their new builds 10% a year. Well, the translation of that, it just would not be shocking to see them putting up 15% earnings growth on that. And I say that because we look at this as U.S. equities are only likely to probably make 2% compounded over 10 years, including the dividends reinvested. So most of the returns of stock markets, you know, looking at U.S. stocks, are going to come down to who grows earnings, because the multiples are likely to eat at returns. They're going to reduce returns. They're not going to enhance returns. So we're not coming to investors saying, hey, these housing stocks are cyclical, and normally they trade at anywhere from 10 to maybe 14 times earnings. You should want to pay 20 times at some point. No, we're coming to them saying there is a compounded earnings growth story in here, that you don't have to worry about getting higher or lower multiples. Most of the return is going to come out of the earnings, which is vastly different than the U.S. equity markets the last 3 or 4 years, where the entire return came down to either buybacks for companies or multiples moving higher. Very little of it had to do anything with earnings growth.
In terms of picking the winners of the next few years then, Cole, you talk in your notes about survivorship bias. What has the race to survive over the last few months taught us about the robustness of various companies and sectors?
Oh, it's a great question. And the perfect picture of survivorship bias, it's your point in my note, I mentioned analyzing planes coming back from World War II, and everyone wanted to look at where the bullets were. And you had to look where the bullets weren't, because the planes that came back, you couldn't analyze the data. And so the survivors didn't actually show you what you needed to know. And that's a perfect picture for today's equity market. The survivors, the biggest cap names out there that everyone knows, they're just the survivors, but they don't teach you anything, because the survivors never do. If you look back, in 1980, IBM was the largest company in America. And that all it told you is it did well and it was big. And you woke up 10 years later, it was still the biggest company in America. The catch was that it did terrible during that 10-year stretch relative to the average stock. So what is going on right now? That survivorship bias is setting up people and investors just to performance chase like you've never seen. I'm 36 on it. This is the first. Oh, go ahead.
But doesn't it tell you something about balance sheet resilience, quality of management, to give you those clues?
It tells you what you just passed in the rear view mirror. That's all it teaches you. Because humans performance chase, that's all they do. So that's the great part to this, is humans can't change. We actually think there are some people in economic theory and behavioral finance that think that the tools we put at the hands of investors makes them smarter. That's just a flat lie, because humans do one thing really good. They buy high and they sell low. And I 50 years from now, I will be able to sit here on your guys' program and say that. And that's the wonderful part to this. So, like I said, at tops, you run out of buyers. That's what we're dealing with right now. The performance chasers just got doing $500 billion of call buying in the 4 weeks ended last Friday. Just to give you a sense, it was only 100 billion in the late 90s. This is a financial euphoria, no different than any other. It's the first time that my age group, the millennials in America, have done this to levels that they will make themselves poorer on.
Cole, thanks very much. A lot to think about there. Cole Smead Capital Management President and Portfolio Manager. Cole will be continuing his conversation with me on Bloomberg Radio at 9 a.m. UK time. So after this program, head to Bloomberg Radio. Let's get a Bloomberg Business Flash for you now. Here's Laura Wright.
Thanks, Anna. Rolls-Royce says it's continuing to think of ways to bolster its coffers after the pandemic slump in aviation revenue. The UK maker of wide-body turbines may issue new debt or equity. It's been particularly hard hit this year, with its share price down over 2/3 and its debt downgraded further into junk. Bombardier says it's selling its rail unit to French train maker Alstom at a lower price than the two sides agreed, but that it will close the deal earlier than expected. The new terms are based on a reduced enterprise value for the unit, down $350 million. The firm's bonds and shares rose on the news. Thinking of buying a new car, European car sales plunged by nearly 1/5 in August, dashing hopes of a recovery. It suggests the market could remain depressed until the end of the year. The results snapped a 3-month streak of easing declines. In July, they only fell 3.7% from a year earlier. That's your Bloomberg Business Flash. Anna.
Decade. We have the details next. We'll also talk about the European banking sector as the ECB allows temporary relief in banks' leverage ratios. This all to do with the response to COVID-19. So more on US and European banks shortly. This is Bloomberg.
thrilled with the reception. We really started assembling our institutional ownership, a little bit over a year ago. So this is really not something of the last couple of weeks. We had people, buy into a tender offer we did earlier, January, February timeframe. So Snowflake is really a heavily vetted company. So by the time we got to the IPO, there was really high conviction into buying into the offering. So we're thrilled with the way things have gone this week.
So talk about conviction. Shares more than doubling. You priced at $120 a share, closed at $253. That said, you left a lot of money on the table. I mean, do you have any concerns that you've given the bankers a little too much here?
Well, the assumption is always that, we could have sold the entire offering at the number that we closed at. And obviously, there's such a thing as a demand curve. There's always investors that are, willing to, buy some number of shares at higher prices. But, as you know, the IPO is a price discovery process, and we were after a very specific set of institutional investors, people that can hold multi-billion-dollar positions that are willing to hold down for 5 to 10 years, and also people that don't chase momentum either up or down. So that's really how we landed at our price. It's not unusual for a price to get chased up by momentum players and retail and so on. So there's a lot of noise to it. So the idea that we could have sold the whole thing at the price that we closed at, I don't think is reasonable. So.
That said, is there a lesson here for some of the other companies looking to go out of the gate? We've got huge public debuts expected for some other huge companies in Silicon Valley, Airbnb, Palantir. Any advice? It's hard for people to price a high growth asset because high growth asset is how fast is it going to grow into its valuation, right? So you need to really do a lot of work with investors. Because they have to make a long-term bet, right? This is not a 12-month deal. People are buying in for 3, 5, 7 years, and they need to understand the story extremely well to be able to do that and have the conviction. I mean, one of the reasons, why the stock ran up and we were really delayed in trading is because we just had no sellers. People were just hanging on for dear life. So that sort of slowed things down a bit today. Now, investors are seeing an opportunity here to disrupt Amazon because what you offer, it's basically your own version of a data warehouse. Amazon does have a similar product. What do you have on them?
Well, what we have on the whole industry is really a product that was built from the ground up, clean sheet of paper, by a group of people who were some of the world's greatest database technology architects, people that really understand the technology really well. Also, what it was lacking all this time. And, when it gets completely redesigned, reimagined for cloud scale computing, you end up with a completely different product architecturally. And something that innovates on multiple vectors at once. And you compare that to what other people are offering out there. They're all trying to carry legacy architectures, software designed for machine computing to the cloud, and they find out that they really can't take advantage of cloud scale, and that's sort of what you see going on. I mean, Snowflake is a deceptive product because it's incredibly powerful given the underlying platform, which is the public cloud. We only run on a public cloud, and we have zero legacy in terms of older machine architectures.
That was the Snowflake chairman and CEO, Frank Slootman, speaking to Bloomberg, speaking to Emily Chang after its euphoric IPO yesterday, which transformed the 8-year-old company into a business now more valuable than Uber, Dell, and General Motors. Now, job cuts are back at the world's biggest lenders. After a pause during lockdown, banks from Citi to HSBC have begun to slash their workforces, putting the losses on course to top last year's levels. Here with the details of this and other news from the European banking sector is Danny Berger. Danny?
Anna, that's right. I first want to start, though, with some headlines coming out of the ECB. They're giving lenders some temporary relief when it comes to their leverage ratio, their Tier 1 leverage ratio. Of course, a way to judge how liquid or illiquid these banks are. It looks at total core capital to total assets. Well, that total assets part can now shrink because they no longer have to count central bank exposure. So they're not going to get a penalty for holding cash at the central bank. Right now, as of the end of March 2020, their leverage ratio was about 5.36%. It's expected that this move will shave about 0.3 percentage points off of that leverage ratio. But there's other trouble in store for banks. Anna, this is what you were talking about, job cuts coming throughout the industry. Now, at about 60,000 job cuts that are planned for this year, we are well on pace to exceed last year's level of job cuts. And if we do that, that means this year we'll see the biggest termination of lender workforces since 2015. Now, there are a lot of costs that banks want to save, and especially because when you have these piling loan losses, you have consumers who aren't spending as much, you have regulatory costs to keep up with, and as well as new technology, digitalization that these banks are betting on. Now, when you look at where these cuts are coming from, the majority is Europe. It's no secret that European banks have been in pain. The ECB announcement today, of course, helping some of that perhaps, but it looks like about 78% of these cuts are coming from lenders who are based in Europe. You can see the share in North America is much smaller. So the U.S. lenders little bit more immune here. But within this European portion, 35,000 are coming from HSBC, was the cuts announced in February. So that's where most of them are coming from, Anna.
And really interesting, just to underline, the ECB allowing temporary relief in banks' leverage ratios, just part of a suite of measures that the ECB has brought forward to assist banks, as we ask banks to assist global economies in surviving this. Let's get to the next part of the programme shortly. Oxford Biomedica will be joining us in just a few minutes' time. This is Bloomberg. Welcome back to the European Market Open. 30 minutes into a trading session that is negative for European equity markets. Off lows, though, down by 0.9% of 1%. The FTSE 100 down by 0.8%, but it's in good company. We've got other markets moving to the downside here in Europe. US futures also point lower, down by 1.6% on NASDAQ futures, but there again, off lows, all in reaction to the Fed and what we heard there, their assessments of the US economy. Let's get to the sector picture across European equity markets. We've got the worst performing sector is banks. We had a headline earlier on around the ECB and the support they're going to offer to banks in the form of giving them a sort of lighter touch when it comes to leverage ratios. You might have expected that to help the banking sector. Hasn't seemed to particularly. We haven't seen much movement there. It's the biggest losing sector today. Just a bit of breaking news. Let's get to that around Uber, around the ride-hailing service that is Uber. Uber is said to seek a partial sale of its $6.3 billion stake in Didi. So this is an interesting story for us to bring to you with regards to Uber. Said to seek a partial sale. The US ride-hailing giant has got the stock, as it did exited China. SoftBank, we understand, is involved in the discussions for Uber to sell its stock. This is all according to people familiar with the matter at the moment. Let's get a Bloomberg First Word News update. Here's Laura Wright.
Thanks, Anna. The Federal Reserve sees rates staying near zero for at least 3 years. At its last meeting before the presidential election, the central bank vowed to delay any tightening until the US gets back to maximum employment and 2% inflation. The Fed will now allow inflation to overshoot slightly after periods of underperformance. President Donald Trump isn't happy with what he's heard about the terms of the Oracle TikTok deal, but says he won't be briefed on the specifics until this morning. Sources have told Bloomberg that the top White House officials have raised concerns about the proposal. They say it falls short of satisfying national security concerns. Democratic presidential nominee Joe Biden is warning about the impact of the latest Brexit plans on a potential trade deal. He says an agreement depends on the continued respect for the Northern Ireland peace process and the Good Friday Agreement. The intervention shows the government's plan to renege on parts of the EU divorce agreement may make other deals more tricky. Global News 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thank you. Laura Wright here in London. Now, Oxford Biomedica expects to receive additional revenues in excess of £35 million until the end of 2021 surrounding the coronavirus. That is, if they find if the vaccine that they are producing for coronavirus is continued into 2021. The gene therapy company, along with Oxford University and AstraZeneca, is part of an alliance that is rapidly developing, scaling, manufacturing a potential vaccine for COVID-19. John Dawson is the CEO of Oxford Biomedica, and he joins us now. John, really good to have you on the programme. I should say, of course, Oxford Biomedica are involved in the manufacture here, not in the testing of this vaccine at this point, but you are already manufacturing it. Can you give us any insight, John, into how that is going, whether you've reached any hurdles, what way through the order you are, any kind of insight into how the manufacturing process is going?
I have to be reasonably guarded about that, but it's going extremely well. We are scaling up to 1,000-litre bioreactors. We started out from 200-litre bioreactors. We plan to produce batches throughout 2020 into 21, and again, we think we'll play a big part in supply as AZ need to satisfy their customers. So we're very excited about this. We're really pleased to be playing a part in fighting the pandemic with AZ and the government, and we're very excited to drive this forward.
Yeah, can you give us any sense of the size and scope of your involvement as part of what is an incredibly fascinating and important global effort?
Our part is really to make the drug effectively. We're doing that in our suites. We were fortuitously just finishing off a new manufacturing plant towards the end of 19 when the pandemic hit in Q1. We had some capacity in our manufacturing suites, which would suit the job exactly. We spoke with, first of all, the Jenner Institute. We were part of that consortium. AZ then became involved and now contracted us to work throughout 20 into 21 to make sure we produce enough vaccine. We'll be doing probably tens of millions of doses, I'd imagine.
And I know that this vaccine is being produced at risk in the sense of financial risk. So obviously the trials are ongoing, and everybody hopes that this drug will be, this vaccine will be successful. But there is financial risk, I suppose, for producing it. Is the risk yours? Is it AstraZeneca's? Is it shared? How does that work?
We've had an upfront reservation fee of £15 million from AstraZeneca towards batches going forward, and that will be refunded against batches throughout 20 and 21. If the drug were not to go forward, we keep that, so we would have no financial loss. We've also done a lot of process development work, which we've been paid for as well. I'd hasten to add, we're not charging our normal commercial rates here. We are doing this because we want to play a part in fighting the pandemic.
Okay, yeah, important to make that point, I'm sure. In terms of the rest of your business, John, and what you do on a day-to-day basis, obviously you'd scaled up, anticipating more partnerships around your regular business, not having to cope with the pandemic. So in terms of the rate at which you're gaining those partnerships, is that going to be, you've added many in the last 12 months, are you going to keep up that pace of additions?
Of course. I mean, we're working on the vaccine around the pandemic here, but also we're making sure in no shape, means or form will it affect our core business, our lender vector business, because that's what we do day by day. This is to an opportunistic approach to try and help the fight against the pandemic. Our core business and our partners and our new partners coming in later this year will not suffer from this whatsoever.
You balance your own gene and cell therapies and also providing manufacturing facilities to other partners that want to use your lenti vector delivery mechanism. What balance of those two do you want in the future? Because this seems to offer quite different revenue streams, I suppose.
We've always been, and we started out many years ago as a product company, and then we found making our own drug that people found what we did very attractive. The barriers to entry of trying to do lenti vector manufacturing, the delivery platform here were quite tricky. So we found a lot of people came to us, and now we have some fantastic partners. We've balanced that with doing our own drugs as well. We have our own proprietary platform. We did a great deal back in 2018 with Axovant around actual NTPD, a drug for Parkinson's. That's progressing well. And we have the choice in each situation there to either license out our drugs to a partner or keep the proprietary portfolio in-house and do it ourselves. So we have that. But one of the big important factors you have to think about in gene therapy is manufacturing. It's been the downfall of a few companies. We have that, which is running extremely well. We probably lead the world in lentivectors, and so therefore, if we're making lentivector products, we have that part sorted already because we do it so well.
Talking of the partnerships that you have, John, I know at one point, or I think at one point, Novartis was the source of more than half of your revenue. How have you managed to diversify the number of partners that you're getting money from?
Well, it's actually performance with Novartis that's actually made people stand back and think how good we are at what we do. We worked with them to get to market. We had our delivery platform approved by the FDA when Kymriah was approved. And then, of course, that gives you the quality systems to attract other partners too. So we've had a lot of approaches. It's been an interesting year because normally we have people all over the world at conferences, at other companies talking to them. No one's left the country, I don't think, very much at all since March. So we've done quite a few deals since then, have a lot more ongoing as well. So I think it's interesting how you can see a business practice changing. These things can work by Teams, by Zoom. It's great to do it face-to-face at times, but we do learn a bit from this about how we work in the future, I think, as well.
And for those who don't follow the gene and cell therapy industry daily, John, how big do you think it can get? How big can this sector be compared to where we are now?
It can be a lot bigger. I mean, we built our new factory based upon the fact that we saw demand for just lentivector manufacturing. Forget the other part of the business model, royalties, for a second. Just that would be $800 million at least by 2026. And we believe we can have at least a third of that, maybe a bit more. So we see a huge market, ever growing. We think gene and cell therapy will play a huge part in healthcare in the future. So we see this growing very, very quickly. And again,
John, thanks very much.
No problem at all. Good to talk to you. Thank you.
Yeah. Thanks for your time. John Dawson, the Oxford Biomedica CEO, joining us to talk about the results and that partnership with AstraZeneca. Up next on the programme, a Brexit compromise, sort of. Boris Johnson has made a key concession to members of his own party to get the controversial Internal Markets Bill through Parliament. We'll speak to one of the draft law's critics, though, who's now in the House of Lords, former Conservative leader Michael Howard. This is Bloomberg. Welcome back to the European market open at 42 minutes into Thursday's trading session. European equity markets down by around 0.9%. Just getting some breaking news coming through. China considering a proposal to boost clean energy in a 5-year plan. We heard yesterday from the European Commission President Ursula von der Leyen about plans on the climate front in this part of the world for the European Union at least. And then Commerzbank retail head Michael Mandel steps down. Another red headline for you across the Bloomberg. So lots of breaking news coming to us this hour. 8:42 here in London. Let's get a Bloomberg Business Flash. Here's Laura Wright. Thanks, Anna. The latest version of Sony's gaming console, the PlayStation 5, will go on sale November 12th in the US for $500. That matches the price of Microsoft's upcoming Xbox Series X as the two companies battle for market share. Pricing is often an important factor of success. Historically, the less expensive systems sell more, driving an increase in revenue from games. A Citigroup employee has been placed on paid leave pending an investigation after revelations he operated a prominent QAnon conspiracy theory website. A fact-checking service identified Jason Galenis as running the site, which has since been shut down. No specific comments from Galenis or Citigroup, but the bank says employees need approval for any outside business activities. Rolls-Royce says it's continuing to think of ways to bolster its coffers after the pandemic slump in aviation revenue. The UK maker of wide-body turbines may issue new debt or equity. It's been particularly hard hit this year, with its share price down over 2/3 and its debt downgraded further into junk. That's your Bloomberg Business Flash. Anna. Laura, thanks very much. Laura writes in London. Now, Boris Johnson has made a key concession to try to get his controversial internal markets bill through Parliament. After a meeting with members of his own party who were threatening to rebel against him, the Prime Minister agreed to give MPs a veto over whether the government can override parts of the Brexit divorce deal. The plan has also come under fire by senior members of the House of Lords. Let's speak to one of them now. Joining us now is Michael Howard, Lord Howard, Conservative peer and former leader of the Conservative Party. Lord Howard, good to speak to you. What you've heard so far from the government, assuming you have heard the proposals from the government, have you heard enough to make you change your mind?
No.
You haven't heard, or you don't like the detail?
No, I've heard of no. I know what the proposal is, but it's not enough to make me change my mind.
Is there anything that the government could do with this internal markets bill that would make you change your mind?
Yes, my objection to this bill is that it invites Parliament to use its sovereignty. Parliament is undoubtedly sovereign in the United Kingdom, but it invites Parliament to use its sovereignty to break international law. And I don't think Parliament should be asked to do that. I don't think the government should have asked Parliament to do that. So the only thing that would satisfy me, as far as I can see at the moment, is if the government were to withdraw from the bill those parts of it which would breach international law. Not all the bill is against international law, but some parts of it are.
Do you think that that is a view that is shared by some in the House of Commons in your party who have said that they will not vote for the bill?
I really have no idea. I mean, it sounds, from what I heard last night on the media, as though a number of those who had previously said they were unhappy are now content. Whether there are some of them who agree with me, I just don't know.
There was a mechanism written into the withdrawal agreement for solving differences that maybe had not already been solved through the earlier parts of negotiation, the joint committee. Do you know why the government has not gone down the route of trying to use that to resolve these tensions?
No, I don't, and you've put your finger on it. My whole argument is that those processes have to be used. In fact, there's an article in that withdrawal agreement which commits both the UK and the EU only to using those procedures to resolve any disputes. It's Article 168. And that's what I think the government should be doing. If it can't reach agreement in the Joint Committee, then the procedure set out in the withdrawal agreement is to go to independent arbitration. That's what the government should be doing, not threatening to break the law.
Why do you think the government has chosen this path, Michael? Do you think it likes the heat that this creates?
I'm afraid you'll have to ask the government that question. I'm not able to see into Boris Johnson's mind.
Okay. What about the response that this bill will get if it does get to the House of Lords? So if the Commons passes it, what will be the approach that will be taken in the House of Lords, do you think? I mean, will you try to stop it? Will it be deemed to have been in the manifesto or not at all, and therefore the Lords will try to stop what the government is trying to do here?
No, the manifesto was the election and the manifesto were on the basis of this withdrawal agreement. The election was in December last year. This withdrawal agreement was in October. So the government was fighting the election on the basis of this withdrawal agreement. I think the bill will have a really rough passage in the House of Lords. It may be that the last night's concession will satisfy some of my fellow Conservatives, but the Conservative Party doesn't have a majority in the House of Lords. I think virtually every peer who isn't a Conservative will probably vote against it, and quite a few Conservatives, including myself.
Do you think that then this will be delayed in a meaningful fashion in the Lords as we approach December the 31st?
I think that's highly likely.
Will that cause trouble navigating the move into new territory next year? What will the net effect of what happens in the Lords be, do you think?
Well, I think the Lords, as far as I can see, the Lords have the power to block it, not permanently, but they have under the Parliament Act, they have the power to block it for a year. Normally, what happens is that in the end, the Lords give way, and the House of Lords doesn't use that power. But I think on this issue, which is so fundamental and such an issue of principle, I think the Lords may well insist on blocking the bill.
Clearly, Lord Howard, you have objections, as you say, which are based on principle and around the legality of this. Others are concerned about what this does to the prospect of a trade deal with the United States. Joe Biden has said that he's concerned about the Good Friday Agreement. Do you think that the Internal Markets Bill is at risk of jeopardizing future trade deals, in particular with the US?
Well, there are clearly concerns in the United States. To be perfectly honest, in my opinion, those concerns are misplaced. I think the Good Friday Agreement is a red herring in all this. In my opinion, there was never likely to be, and there won't be, a hard border on the island of Ireland, whatever is agreed or not agreed. The head of Her Majesty's Revenue and Customs, who, as you know, is the principal civil servant in the UK dealing with customs arrangements, is on the record as saying that even if there's no deal at all, there'll be no need for any infrastructure at the border on the island of Ireland. So in my opinion, that's a bit of a red herring. My objection is not to do with the Good Friday Agreement. I'm in favour of the Good Friday Agreement, but I don't think it's at all imperilled by this bill. My objection to it is that it invites Parliament to break international law.
Okay, thank you very much. Michael Howard, Lord Howard, UK Conservative peer and former leader of the Conservative Party. 50 minutes into European trading this morning. Up next, how much more stimulus do risk assets need? We will put that question to Laura Cooper, our Markets Live macro strategist. This is Bloomberg. Welcome back. This is the European Market Open. 53 minutes of a trading session that shows a negativity for Europe, down 0.9%. Off lows, though. Let's talk about the markets and where we are with Laura Cooper, our Bloomberg Markets Live macro strategist. A real negative response from global risk assets then to what we heard from the Fed, Laura, yesterday. Does that make sense to you?
Well, I mean, I certainly don't think that the Fed was the catalyst for this retrenchment in risk assets, because we did see that investors' nerves were already kind of frayed based on the price action that we saw earlier when risk assets were under pressure. And I think what we saw earlier this week was really just a case of this wait and see. So risk assets in this holding period, awaiting to see whether the Fed could actually meet very dovish market expectations. And clearly they didn't. Clearly they're less dovish. More stimulus is likely not in the pipeline. And I think risk assets that have been propped up on stimulus are really just reacting to that in a knee-jerk fashion.
Yeah, propped up on stimulus of various forms. How much stimulus do we think that risk assets really need? Do you think markets are hoping, expecting that they get something on the fiscal side from the US?
Well, I think that's really the question. It's less a question of how much more stimulus is needed, but really where it's going to come from. I think the fact that we are seeing this less dovish messaging across central banks is just shining the light on the gaps in terms of fiscal stimulus. So yes, rates are on hold in the U.S. We're not going to see potentially a greater amount of bond purchasing there. So really that lies on the fiscal front. And we are seeing that on quite shaky ground because the prospects don't look good. So really markets are grasping for the next catalyst in terms of propelling this buy the dip mentality that has prevailed. And clearly that's falling short because we aren't seeing these positive signs that we are going to see this stimulus needed in order to really continue to have these economic recoveries be sustained.
I talked to a guest earlier on in the program, Laura, who said that he thought the Fed will be caught out in the years ahead with rates too low and that inflation is coming back. What's your assessment of inflation?
Well, I think really at this stage it's quite interesting, just the fact that you really average inflation targeting. What does that mean? We don't have a clear guidance around how hot is hot for inflation, how long can inflation run hot, and really there is the risk that if we do potentially see inflation sustained above that 2% target, if we do see full employment, then the Fed could be caught behind the curve, and that could certainly shake risk assets if they do have to tighten quite quickly. But I think at this stage, really, inflation remains quite elusive. I think when we look at, yes, we have this ample liquidity in the system, but that's not actually being funneled to the real economy. So I think really at this stage, until we see kind of this private sector impulse of firms and consumers going out and spending, we really aren't going to see those price pressures for quite some time. So I think from the Fed, they're able to kind of take this easy stance for some time, but certainly it does remain a tail risk going forward.
Laura, thanks so much. Thanks for joining us. Laura Cooper, Bloomberg Markets Live macro strategist. That is it for the European Market Open. Stay with Bloomberg Television. Surveillance, of course, is up next. They'll be taking you through the latest market action. European markets, then risk markets to the downside. We're down 0.9% on the stock 600, although buying of the dollar has been unwound a bit. We're now fairly flat on the dollar index overnight, but we still see U.S. futures under pressure. NASDAQ futures were down 2%, now down 1.5% or so. So we're set up for perhaps a negative session on Wall Street. Surveillance will build you up to that. This is Bloomberg.
3 more years. The Fed predicted rates will stay near zero through at least 2023, but Jay Powell's caution on the economic rebound weighs on stocks. Standstill expected dovish noises from the Bank of England today, even as rates go nowhere. In Westminster, Boris Johnson makes a key concession in a bid to get his Brexit plan through Parliament. And President Trump contradicts his health officials, saying a vaccine could come by October. Global coronavirus cases near 30 million as the death toll approaches 1 million. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London. Let's check on the markets. A lot of the focus, of course, is on what Mr. Powell said yesterday and what we heard from the Fed. So we're seeing a bit of movement across the board. If you look at some of the European stocks, they're actually retreating after Jay Powell highlighted uncertainty about the economic rebound. We also saw a gauge of Asian shares actually falling the most in a week. And then a couple of other things is the Treasury yield, that curve steepening slightly on Wednesday after Mr. Powell stopped short of offering new specifics on the Fed's approach to the monthly bond purchases that really have buttressed markets. Now let's get straight to the Bloomberg First Word News. Here in London with me is Leanne Gerrans. Hi, Leanne.
Good morning, Francine. President Donald Trump isn't happy with what he's heard about the terms of the Oracle TikTok deal, but says he won't be briefed on the details until this morning. Sources have told Bloomberg that top White House officials have raised concerns about the proposal. They say it falls short of satisfying national security concerns. Now, President Donald Trump says a coronavirus vaccine could be widely available as early as October, contradicting his top health officials. They've made estimates ranging from March to the end of 2021. Expert Anthony Fauci told Bloomberg he's reasonably confident a vaccine will be available by the end of the year, but that wide-scale adoption does indeed take time. Here, Prime Minister Boris Johnson is making key concessions on his Brexit plan to get it through Parliament. He's agreed to give the House of Commons a veto on whether the government can override parts of the divorce agreement. It comes as one of the government's most senior legal officers resigned over the controversial proposals. And the European Central Bank is giving lenders temporary relief on their leverage ratios. The ECB's new measure allows the banks to exclude central bank exposure from the calculation. Based on data from the end of March, that would raise the average ratio by about 0.3 percentage point. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, Bank of England officials are expected to lay the groundwork for more monetary stimulus at today's rate-setting meeting. That's as optimism over the UK's economic rebound fizzles out. Well, forecasters don't see immediate action, but they widely predict the bank's bond-buying program will be expanded again before the end of the year. The market also expects the key base rate to be cut below zero in 2021. Well, joining us this morning is Deanne Julius, Distinguished Fellow at Chatham House and former BOE Monetary Policy Committee founding member. Deanne Julius, thank you so much for joining us today. If the Bank of England, you know, how dovish can the Bank of England actually sound today, given all the headwinds they're facing?
Well, I think they will sound uncertain rather than dovish. It does seem to me that there's a huge amount of uncertainty around at the moment. But remember that the strategy that they laid out, that Andrew Bailey laid out early on in the COVID crisis, was to go fast, go big, as he called it. They did their big rate cut then. They increased the amount of QE that they would be doing at that point. And I think that it's still the case that that is fueling the economy. We've had some pretty good economic news relative to their forecast, because, of course, the Bank of England's making its decision based on the strength of the news it's had since the last forecast, since the last meeting in August. And I would say the news has been either neutral or positive compared to that forecast. So there's not a big urge to change. The one piece of news that was perhaps surprising to some was that our inflation rate, the CPI rate that they monitor, went down last month to 0.2 compared to the target of 2%. Of course, that's pretty low. You might think that would cause them to think about additional stimulus, but actually it was forecast in their last policy meeting, in their last monetary policy report, that the inflation rate would go down to something like 0.2, 0.25. So again, that's not unexpected news, and it's due largely to some one-off features that they'll be well aware of. So I don't expect there would be a move this time, and I suspect commentators will actually argue about whether it's a dovish or a hawkish stance.
Diane, Julius, what exactly is a perfect time, I don't know, to add more stimulus? Do you have to, front it and do it a little bit before there's a sharp downturn, or we also have that little thing called Brexit looming?
That's true. I think the right time is when there has been a significant and rather unexpected downturn compared to not to last year, of course, but compared to forecasts. But there are also some tactical considerations here. The bank will be making its next forecast update in November. That's when the next MPC meeting will be held. The MPC meeting will be 2 days after the U.S. election in November. That could put a significant amount of uncertainty into the marketplace. That might need some additional liquidity support if it really disturbs financial markets. But also remember that the previous vote of the MPC was unanimous. So even though there are a couple of dovish sounding people, including Michael Saunders, I think most of all, who's paved the way in his speeches for himself to vote for additional stimulus, I think it'll be quite a while yet before the whole committee moves, or a significant majority of that committee moves into that state. So, there are upsides and downsides. Andy Haldane is a little more optimistic about the state of the economy. The labor market's been doing reasonably well, but we're getting to the end of phasing off our furlough scheme. So they'll have to watch that pretty closely. The monetary aggregates are booming, and some of the members watch that. Our broad money supply, M4, is up 25% compared to July last year. So, there's all kinds of, as usual, economic news in the market, and it's a matter of balancing them out and then taking account of anything major that's hitting them from the side. And that could be Brexit news, good or bad. It could be the Chancellor, who is going to be, I think he's going to be coming up with a budget before the November MPC meeting, although he hasn't firmly confirmed that. But there's lots happening, and I think that it'll be events that drive eventual stimulus, if indeed that does happen.
Do we need, Julius, an extension of the furlough programs? Because a lot of the concern of risks to the downside is indeed in the labor market.
There is support around, particularly on the union side, for extending the furlough scheme. I don't really expect it. I think that Rishi Sunak has been pretty clear that it was a temporary scheme. He has now been phasing it out for the last few months. It is due to end, the phasing out is due to end the end of October, so it's still around. At the same time, people have come off the furlough scheme and gone back into work in the last 2 months as the lockdown has eased. So the labor market data is not that negative. I would say it's not positive, but no one expected that to be there. So it seems to me what is more likely than extending the furlough scheme is probably to extend the additional support that comes through job seekers allowance and the what's called the universal credit, which is then targeted at those people who really need it, who really have lost their jobs and need to be looking for something different, rather than being an across the board very expensive extension of the furlough scheme.
Diane, Julius, how much pressure will the Bank of England actually get from markets to talk a bit more about negative rates? What will it take for the Bank of England, if anything, to go into negative territory?
I think it will take a significantly worsening economic situation. It seems to me there's quite a bit of reluctance on the part of certainly Andrew Bailey and some others on the committee to cross that Rubicon. There's not a lot of economic evidence that it does much good. The Swedish experiment, which is the longest running one that we've had that's in Europe anyway, has moved back from negative rates. It does create some strains in the banking system, and the Financial Policy Committee, which Andrew Bailey also chairs, is looking at those sorts of issues around negative rates. So they haven't ruled it out. They certainly are keeping it on the table as an option, but I think it's an option that would be not quite last resort, but it would come after additional QE in this case, simply because it's not clear that it would do a lot of good, and it certainly has negative consequences on the banking sector.
Thank you so much. Deanne Julius from Chatham House stays with us, and we'll talk a little bit about the Fed next. Coming up, 3 more years, Jay Powell says U.S. rates could stay near zero until at least 2023 to help the economy rebound. We'll focus on the Fed next. This is Bloomberg.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Snowflake soared in its stock market debut. Its share price was up as much as 166%, giving it a market value of more than Uber, Dow, and General Motors. Snowflake's $3.4 billion IPO is a record for a software company and the biggest in the U.S. so far this year.
The IPO is a price discovery process, and we were after a very specific set of institutional investors, people that can hold multi-billion-dollar positions that are willing to hold down for 5 to 10 years, and also people that don't chase momentum either up or down.
The latest version of Sony's gaming console, the PlayStation 5, will go on sale on November the 12th over in the US for $500. That matches the price of Microsoft's upcoming Xbox Series X. As the two companies battle for market share, pricing is often an important factor of success. Historically, the less expensive system sells more, driving an increase in revenue from games. And a Citigroup employee has been placed on paid leave pending an investigation after revelations he operated a prominent QAnon conspiracy theory website. A fact-checking service identified Jason Gelinas as running the site, which has now since been shut down. No comment from Gelinas or Citigroup, but the bank says employees need approval for any outside business activities. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Now, 3 more years, the Fed predicts rates will stay near zero until at least 2023 to help the economy rebound. The chair, Jay Powell, says that while the recovery has been faster than expected, activity remains well below pre-pandemic levels.
We believe that particularly this very strong forward guidance, very powerful forward guidance that we've announced today, will provide strong support for the economy. Rates will remain highly accommodative until the economy is far along in its recovery, and that should be a very powerful statement in supporting economic activity. With inflation running persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time, and longer-term inflation expectations remain well anchored at 2%. The labor market has improved, but it's a long, long way from maximum employment, and it will be some time getting back there. My sense is that more fiscal support is likely to be needed. Of course, the details of that are for Congress, not for the Fed. We believe the strong policy guidance we are providing today will serve the economy well by promoting our goals through the many possible paths the recovery may take.
Well, still with us is Deanne Julius from Chatham House. Deanne, how did you take what we heard from the Fed chair yesterday? You know, it's setting out somewhat of a new policy, but actually it had very mixed reviews. I don't know if, you know, everyone interpreted it in the same way.
I thought it was very clever, actually. The Fed has been saying for a long time that they were in the process of reviewing their framework for monetary policy, and we were all speculating would they go to something like GDP targeting, nominal GDP targeting, something else. Having this so-called new framework of average inflation targeting provides them with a lot of flexibility, you know, a lot of wiggle room, if you want to put it that way. They can't be tied down with additional calls for more stimulus month by month as inflation continually hits a point below 2%, below their target. So particularly with the election coming up, I think to have a wider canvas on which the Fed can frame its policy is a good idea. And it also, to some extent, takes off the table the idea of negative interest rates in the U.S., because what Powell talked about was perhaps additional stimulus to keep the economy growing at a more sustainable rate, but that can easily be through financial changes in financial parameters around banks, or indeed in more QE. I did have a look to see what average inflation actually might mean if one looked backwards. Now, the Fed uses that rather strange metric of the personal consumption expenditure deflator without food and energy. So if you just take that data, if you went back to 1980, the average core PCE would have been 2.78. If you take the average from 1990, it was 1.9. If you take the average from 2000, 1999 actually, it was 1.7%. So it wasn't too far below 2% if you take that kind of fairly long run period to calculate the average. And in a way, it might be more significant that Powell did not firmly place his new framework on the PCE. You know, the Fed does talk about monitoring different types of inflation indices. And the PCE, this old favorite, or at least the one that Alan Greenspan shifted to, was 0.3% in July, compared to the CPI, which most people follow instead, which was 1.6% without energy and food. So there may well be an additional debate to be had here around just what is it that they're averaging and aiming for.
But does the more specific guidance actually help in reaching those targets just because they're more specific? Or does it mean that they'll have to deploy more aggressive tools to try and get to those targets?
Well, I think it will depend a lot on which direction, not just the level of the inflation rate, but which direction it's going. And I think at the moment there is so much volatility in the data itself, with lockdowns in different places, with different states indeed having different issues, that it's a little hard to place much faith in any of the data. But this change in policy to average targeting as opposed to point targeting, on balance, does indeed give them just more flexibility, and therefore perhaps less pressure to move in a direction until they're ready to move. I mean, it was also interesting that Powell has made the case, at least at Jackson Hole, that the Fed should place equal weight on the unemployment part of its mandate as on the inflation part. And that seemed to come through yesterday in his statement as well. so that in addition to watching inflation and different measures of inflation, they'll be really pulling apart the data on the labor market, I suspect, in deciding whether to put additional stimulus into the economy.
Thank you so much for joining us today, Deanne Julius, they're a distinguished fellow at Chatham House. Now, coming up, the banking call returns. Job losses at lenders this year are on course to be the deepest in half a decade. We have all of the details next. This is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, job cuts are back at the world's biggest lenders. After a pause during lockdown, banks from Citi to HSBC have begun to slash their workforce, putting the losses on course to top last year's level. We're here with the details is our Danny Berger. Hi, Danny.
Hi, Francine. That's right. About 60,000 job cuts so far have been announced for the year. So well on pace, as you say, to beat last year's level, about 80,000. But the thing is, if it does exceed this level, that means we're going to have the steepest reductions in lender workforces since 2015. And keep in mind, this is just the job cuts we know about. Of course, lenders don't always announce to the market how many jobs they're cutting. But part of the reason reason we're seeing it so steep this year is the desire to cut costs when we have these piling loan losses. We have regulation that banks need to spend to keep up with, and then also just some of the digitalization that these banks are doing. So the costs keep on coming. So here's a place where they see that they can save some of those costs. Now, when we dive into that number, you can see that the majority of the cuts are coming from European lenders. This is about 78% coming from the region, much smaller than North America, for example. Now, within this nearly 50,000 job cuts coming from Europe, 35,000 of them are from HSBC. So that's where the bulk of it comes from after an announcement they made in February. We can't forget the human cost of this as well. It's a tough year for bankers to find new jobs. According to recruiting firms, jobs posted in London last month sunk by about 40%. So there are definitely less listings out there as well for new jobs for bankers.
Thank you so much. Our Danny Berger there with the very latest on some of these banks. Now, coming up, Dr. Anthony Fauci says it's unlikely a COVID-19 vaccine will be available to the public by the date of the presidential election. We'll have plenty more from the top U.S. health official next. We'll also look at COVID-19 and the markets. Jay Powell really upending some of the things that we saw in terms of asset classes. European stocks at the moment are retreating. U.S. futures also down after Jay Powell highlighted uncertainty about the economic rebound. I'm looking at treasuries. They're actually ticking up. I'm looking overall at some also the industries here in Europe that are under pressure. Automakers slumping after we saw data showing that European car sales plunged by nearly a fifth in August. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The Federal Reserve sees rates staying near zero for at least 3 years. At its last meeting before the presidential election, the central bank vowed to delay any tightening until the U.S. gets back to maximum employment and 2% inflation. The Fed will now allow inflation to overshoot slightly after periods of underperformance.
I believe that particularly this very strong forward guidance, very powerful forward guidance that we've announced today, will provide strong support for the economy. Effectively, we're saying that rates will remain highly accommodative until the economy is far along in its recovery, and that should be a very powerful statement in supporting economic activity.
Now, Democratic presidential nominee Joe Biden is warning about the impact of the latest Brexit plans on a potential trade deal. He says an agreement depends on the continued respect for the Northern Ireland peace process and the Good Friday Agreement. The intervention shows the government's plan to renege on parts of the EU divorce agreement may make on other deals more tricky. And Deutsche Bank has told its New York City staff they can continue to work from home until mid-2021. That's in contrast to rival banks that are seeking to return employees to the office. In a memo, Deutsche Bank says workers only have to return when the bank moves into its new offices, which is happening in July. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Now, top U.S. infectious disease expert Anthony Fauci says it's unlikely a COVID-19 vaccine will be available to the public by the end of the presidential election. He spoke with Carlyle Group's David Rubenstein for the Bloomberg Equality Summit.
The Department of Health and Human Services says that its plan is to have everybody vaccinated by the end of the first quarter of 2021. In your view, is that realistic to occur?
You know, that is possible, David, but to get everyone vaccinated, I think logistically, that is going to be tough. I mean, there will be tens of millions of doses available by the end of the year and in the first quarter. As you get to the end of the first quarter, there'll be hundreds of millions of doses. Whether or not you can get injection into everyone, and remember, it depends on what the vaccine is. If it's the Moderna vaccine, it's a prime followed by a boost 28 days later. So I think we need to be careful. It will be aspirational to do that, David, but I think it's more towards the middle to the end of the year that you could get people vaccinated.
And are you reasonably confident that by the end of this year, this calendar year, one, two, or three vaccines will have been approved by the FDA?
Well, yeah, will have been made available in the sense of either by the formal approval or by an emergency use authorization. But to repeat your question with a firm answer, by the end of 2020, namely November or December, I feel reasonably confident that there will be one or more vaccines that will be begun to be being made available to the American public.
That was Dr. Anthony Fauci speaking to Bloomberg for the Equality Summit. Now let's keep the conversation on the pandemic. Shares in Tiziana Life Sciences are up after the company announced it's starting human trials in Brazil of its COVID drug. Now it's called Forelumab. It's administered nasally, and the hope is that it can reduce the risk of respiratory failures in COVID-19 patients. Well, joining us now is Gabriele Cerrone. He's chairman of Tiziana Life Sciences. And Gabriele, I know it's very early days to see exactly what will come out of it and some of the things that we'll see in the future. But, you know, overall, some of the industry, the biotech industry, has really been seeing huge swings. Do you feel like there's, you know, enough scrutiny on some of the things that the industry is doing?
Well, as I mentioned when we spoke back in June, Francine, there's been a big rush to get a vaccine and other therapies to the market, commonly associated with political agendas. And I am concerned that there is not enough clinical data to meet these rapid deadlines to introduce vaccines to the market.
But Gabriele, do we need to hear from the regulators more? Even, you know, when it comes to a vaccine, which I know Tiziana Life is not involved with, a lot of people may not want to take the vaccine unless we hear not from chief executives, but from the regulators, from the people that say it's safe for you to take it. Does that need to change? Do we need to have a stronger dialogue directly with the people that give the green light?
Well, unfortunately, it's hard for the general public to have a direct dialogue with the Food and Drug Administration because it's in the United States, for example, it's regulated directly by the White House. And you've seen a lot of battling going back and forth between the Trump administration and the Food and Drug Administration with respect to how lenient they would like them to be with allowing new therapies and vaccines to come to the market. So unfortunately, the general public doesn't have a direct dialogue, but yes, we need the FDA and other European governmental regulations to act more independently in the best nature of the safety of the general public, especially considering we don't know enough about this virus. It's been around for 8 months, and there are side effect risks that cannot be truly looked into deeply after only 7 to 8 months of testing of both vaccines and drug therapies.
Gabriele, do you see, I mean, what's the state of share prices in the biotech industry right now? Is there a danger that, you know, part of your business or part of your industry is actually in bubble territory because of the appetite, because of, you know, what you're trying to do and everybody waiting for these vaccine or therapies?
So, Francine, I would split it into 2 areas. I think there was quite a bit of a COVID bubble back in end of June and all of the month of July. But with respect to the overall biotech sector, I do not believe we're in a bubble. I believe we're in the beginning of a bull market. When the Sputnik vaccine in Russia was announced back in mid-August, there was a massive sell-off in COVID-19 related stocks. And that in turn dragged down the general biotech index. That being said, we are looking at, in my opinion, the beginning of a 18-month to 2-year bull market, primarily because, Francine, in this kind of environment, when fund managers, family offices, the greatest wealth on the planet need to move their money into sectors, they're very reluctant to invest in commercial real estate, leisure, food industry when people can't travel. So investing in biotech industry and pharma is a natural no-brainer because with the pandemic going on, you know that it's an area that's just going to go from good to better.
Gabriele, give me a sense of whether, you know, because of this renewed investor appetite or investor spotlight, you think it will lead to a lot of M&A in your industry?
Well, we just saw 2 days ago, Gilead Pharmaceuticals acquired Immunomedics for $21 billion. This is the biggest acquisition of the year and the biggest acquisition in the history of Gilead. And Gilead has been one of the most successful biotech companies of the decade as it virtually cured the hepatitis C virus with Sovaldi. So it's their biggest acquisition. I think it's the beginning of many to come. We're excited about the $21 billion investment into the breast cancer field because Tiziana Life Sciences announced back in May that we have the most accurate prognostic test for predicting whether breast cancer patients will risk getting their cancer again. So we're excited about Gilead's $21 billion spend into the breast cancer space.
Gabriele, give me a sense of whether you've been approached for M&A. Have you had people circling Tiziana Life Sciences?
We can't comment on M&A, but what we've done, just long-term planning, is after the successful data we reported at the ASCO Cancer Conference on our stem printer breast cancer prognostic test, we decided to separate it into a separate vehicle and list it on the London main market this coming November, because we want to plan long term that if there is an M&A approach, that we separate assets which will create the most value for our shareholders, given that we have an ample therapeutic pipeline. So what we've done is we've decided to separate our prognostic and diagnostic pipeline into a separate company, which we're going to be listing on the London main market and on NASDAQ in the first quarter of 2021.
Gabriele, do you feel pressure from governments to actually come up with, some of the therapies? Do you sometimes feel like there's too much pressure to getting things done too quickly?
Well, I believe that I feel pressure with myself and the company to develop an alternative to vaccines. And that's what we're doing, because again, as I mentioned when we spoke back in June, I believe there continues to be too much emphasis only on developing a vaccine. And from the results that were announced by AstraZeneca last week, the side effects, I think this will exacerbate, which is already a large fear in the general population, to taking vaccines. So I feel a lot of pressure to develop a therapeutic, an alternative. And that's what we announced today, that we're going to be able to get into human clinical trials almost a year earlier than we expected at Tiziana Life Sciences, to test our nasal spray to treat COVID patients.
And Gabriele, it's also very nice to hear you talk about some of the other developments that you're doing, for example, in treating certain types of cancer. Do you think that because of the focus on COVID-19, there's a danger that as companies race to try and find therapies for this, there's not enough research in other life-saving drugs?
Francine, this subject has come up quite a bit in the last 6-7 months. My answer is yes and no. It depends on how long the pandemic continues. If the pandemic continues for another year, the diversion of concentration on developing new oncology drugs could in fact be dangerous, as you highlighted. If the pandemic were to be reducing itself in 6 months, I think the damage that would have been done in the research and development field from having diverted research and development for 1 year is recoverable.
Gabriele, thank you so much for joining us. Gabriele Cerone, they're chairman of Tiziana Life Sciences. Now, up next, our conversation with Bill Gates. Hear what he has to say about Joe Biden's climate plan. That's coming up next, and this is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacroix here in London. Now, we're just getting some headlines from the Vice President of the European Central Bank saying they're watching the euro closely. And, of course, they say that he says that the inflation outlook will determine the ECB policy, not the level of the euro, still saying that they're watching the currency, a lot. This was one of the concerns that the markets have, was that in her last press conference, the president of the ECB, Madame Lagarde, was not as forceful in saying that actually strong euro could be a concern. Now let's get straight to the Bloomberg Business Flash. Here in London is Leanne Gerrans. Hi, Leanne.
Hi, Francine. European car sales plunged by nearly a fifth in August, dashing hopes of a recovery. It suggests the market could remain depressed until the end of the year. The results snapped a three-month streak of easing declines. In July, they only fell 3.7% from a year earlier. Now, Bombardier says it's selling its rail unit to French train maker Alstom at a lower price than the two sides agreed, but that it will close the deal earlier than expected. The new terms are based on a reduced enterprise value for the unit, down $350 million. The firm's bonds and shares rose on the news. And Rolls-Royce says it's continuing to think of ways to bolster its coffers after the pandemic slump in aviation revenue. The UK maker of wide-body turbines may issue new debt or equity. It's been particularly hard hit this year, with its share price down over 2/3 and its debt downgraded further into junk. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, climate change policy will be one of the many critical issues facing voters in the upcoming U.S. presidential election. Democratic candidate Joe Biden has proposed an ambitious and expensive plan to combat climate change and shift the nation to renewable energy. Well, Bloomberg's Eric Schatzker spoke with Bill Gates in a wide-ranging interview and asked him what he thinks of Biden's approach.
Well, I think ignoring climate change is a gigantic mistake. It's a very tough problem to solve, and it's one that you have to start many decades ahead of when you want that solution deployed, because you're talking about changing most of the physical economy of the world. Transport, industry, buildings, electricity, all of those things, and agriculture contribute to those emissions. And many of these sources of emissions, we have no solution. So, thank goodness that we have a lot of innovation power, that we can be clever about designing policies and incentives to take things like steel and cement, which are very, very difficult, and find a way of making those without a big premium in cost, and yet having those be green products.
You're a realist, especially when it comes to science. How realistic is Biden's 100% clean energy in America by 2035?
I think that will be very difficult to achieve because it's a great goal. We should do the model of the grid to see how you maintain reliability when you're increasingly reliant on intermittent sources. Storage is still way too expensive to make it the way to deal with that. I and many others are funding lots of storage breakthroughs. We're also funding clean sources like fission, that if we made that a lot less expensive and a lot safer, it could play a significant role here. So we don't really have that blueprint. There's an open source model that anybody can plug in what they think that'll look like, and we'll see what is the cost, what is the reliability. But without innovation, a lot of innovation, we won't be able to get there.
And you can catch that full conversation later today, plus more throughout the day from the Bloomberg Green Festival. Coming up, we talk tech, more from our conversation with the Alphabet Chief Financial Officer, Ruth Porat. That's coming up next, and this is Bloomberg.
change is the defining issue of our time. So we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, this is what we heard from the Vice President of the ECB talking about euro, looking at euro levels. So let's check in. If we have that euro level for you, it'd be great. So I have a bit of a look at what exactly we've heard from him. So euro dollar, let me bring it up. But euro dollar currently, you can see not really budging much on what we heard from Mr. De Guindos at 1.1805. Now let's talk tech and the challenges of working from home. The coronavirus pandemic has caused millions around the world to work remotely. The Alphabet CFO Ruth Porat spoke with David Rubenstein about how this shift in work environment has impacted the company's thousands of employees.
When you started working remotely, did you ever worry it would be a problem because you have all these people, but you're technically very savvy?
So when we started the move to work from home, it did seem daunting. I'm responsible for our crisis response and put together a really strong governance around how do we get people to move from home with a global team and then a regional team, and we were in sync daily. That worked really well. What we were most concerned about was what would be the impact on productivity and wellness. Our chief medical officer, very early in the crisis, said that more people would be affected by mental health issues than actually the physical disease itself. So we focused on those two, and I think that was really important. The other thing is Google is really about our people and the ability to deliver for users and communities because of our compute capacity. And one of the things we didn't have to worry about was our ability to really deal with the surge in online activity. And that was because of all of the investments over many years and all of the testing for what could happen in a sort of crisis scenario. And I think it's an important point because you can't solve the risk management issue in the middle of a crisis. You obviously need to solve it ahead of time, and that worked.
So many companies are saying, well, now that I've learned that my people can work from home, maybe I don't need all these people either in the office or I don't need all these people. Is that your view? You don't need all the people you have, or you may not need them all in the office?
We believe that when people are together, that's a critical element for innovation. Collaboration helps support innovation. It's collaboration within teams, and it's collaboration across teams. It's collaboration and it's serendipity. So we do look forward to having people back in the office. What we're looking at is the productivity lift you get if people have the ability to work from home some days, be in the office, in particular when the rest of their team or more broadly teams are in the office. And if you can save people commute time, you have better access to talent because you're solving what people want in their personal life, it's actually going to result in a better outcome. What that means for real estate, we're still figuring out.
Early on, Google was well known for, among other things, you got free food. What about if you're working at home? Do you give them free food showing up by delivery somehow, or how do they compensate for that?
So we're not doing that, but you know, a lot of people focus on food when really what we are trying to create, have been trying to create, is this fun, quirky, magical campus. And so it's about more than just the free food, it's the experience on campus. So what we did when we moved everybody to home is we moved a lot of these sort of connecting the community to a virtual delivery. And so for food, as an example, you can do a one-on-one session with a chef, you can do a cooking class. We took our fitness classes and moved them to virtual fitness classes, and even some sort of goofy Google-style ones like yoga with your dog.
Well, that was the Alphabet Chief Financial Officer Ruth Porat speaking with Carlyle Group co-founder David Rubenstein. Now, Bloomberg Surveillance continues in the next hour. Tom Keene joins me out of New York. Remember Not to miss more from the Bloomberg Green Festival. That's later today. In the meantime, we're seeing a bit of pressure on asset classes. If you look at European stocks, they're actually down. Now, this has a lot to do with what Jay Powell said yesterday. I'm looking at some of the things that also would move on the back of a Fed statement. You can see the U.S. 10-year yield at 0.6822. So European stocks are retreating. I'm also looking at European car sales plunging by nearly a fifth in August, and that means that automakers are slumping. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Three more years, the Fed predicted rates will stay near zero through at least 2023, but Jay Powell's caution on the economic rebound weighs on stocks. Standstill expected dovish noises from the Bank of England today, even as rates go nowhere. In Westminster, Boris Johnson makes a key concession in a bid to get his Brexit plan through Parliament. And President Trump contradicts his health officials, saying a vaccine could come by October. Global coronavirus cases near 30 million as the death toll approaches a million. Good morning, everyone. This is Bloomberg Surveillance. I'm Francine Lacqua in London, Tom Keene in New York. Tom, we have a number of stories, of course, that we need to look at. First of all, we heard from the Vice President of the European Central Bank, Mr. de Guindos, saying that actually they're looking at euro level, and then the ECB also offering a bit of capital relief, more capital relief to banks in order to cope with the pandemic?
They're all flailing away, and you felt that yesterday with Mr. Powell. It was an extraordinary moment for the Fed yesterday. I really can't underscore enough the originality of what was being accomplished yesterday, Francine. It was sitting there with Michael McKee, and of course McKee's press conference question was superb. They're all dealing with what to do with no inflation and no aggregate demand. It's a fascinating time.
Yeah, it certainly is. We'll have plenty more on that. But now let's get straight to the Bloomberg First Word News in New York City. Here's Ritika Gupta. Hi, Ritika.
Morning, Francine. Tom, President Trump has slapped down some of his top health officials. He contradicted them at a news conference, saying that a coronavirus vaccine could be distributed widely to the public by as early as next month. CDC Director Robert Redfield told Congress that the vaccine would be distributed in the second and third quarter of next year. The president called those comments a mistake. At least one person was killed and hundreds were rescued after Hurricane Sally came ashore near the Florida-Alabama line. Heavy rain swamped Pensacola, Florida, and other cities in the region. Sally is now a tropical storm. It could drop up to a foot of rain today in parts of Alabama and Georgia. Attorney General William Barr says the Black Lives Matter movement doesn't care about black lives. Instead, Barr says it wants to use African Americans killed by police as props to advance its political agenda. The Attorney General also suggested the issue of black-on-black crime is being overshadowed by police killings of minorities. Details of that proposed deal between Oracle and TikTok are coming out. Bloomberg's learned that Oracle would get full access to review TikTok's source code. That's to make sure there are no backdoors used by the company's Chinese parent to gather data on the app's American users. The administration still hasn't signed off on the agreement. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. Correlated risk off here. Equities, bonds, currencies, commodities. Futures negative 37. Dow futures negative 246. When I walked on the door, VIX up two big figures. That's a big move back to 27.47. As Francine mentioned earlier, bonds adapt and adjust to what we saw yesterday from Chairman Powell. 10-year yield remarkably stable, 0.68%. 30-year bond comes in off the enthusiasm yesterday. And oil back under, West Texas Intermediate back under 40. Turkish lira really, it's off the radar, Francine. Ian Bremmer on later. I'm not going to waste, Dr. Bremmer's time with lira, but lira is making news right now, weaker.
Tom, I'm looking at dollar steady, as you say, treasuries ticking up. European stocks are actually dropping. They're down some 0.6%. Again, I think a lot of markets, Tom, are focusing on the fact that it was pretty dovish from the Fed chair, Jay Powell, and he, really highlighted the uncertainty about the economic rebound. And certainly here in Europe, it feels like they're picking up on that, instead of the more specific guidance, which could maybe make his life a bit easier. I'm also looking at automakers in Europe, and they're really down after data showed that European car sales plunged by nearly a fifth for the month of August. So in his news conference, the Fed chair, Jay Powell, says the economic recovery has been faster than feared, but the path ahead remains highly uncertain.
We believe that particularly this very strong forward guidance, very powerful forward guidance that we've announced today, will provide strong support for the economy. Rates will remain highly accommodative until the economy is far along in its recovery, and that should be a very powerful statement in supporting economic activity. With inflation running persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time, and longer-term inflation expectations remain well anchored at 2%. The labor market has improved, but it's a long, long way from maximum employment, and it will be some time getting back there. My sense is that more fiscal support is likely to be needed. Of course, the details of that are for Congress, not for the Fed. We believe the strong policy guidance we are providing today will serve the economy well by promoting our goals through the many possible paths the recovery may take.
Let's get straight now to Joyce Chang. She's the JP Morgan Chair of Global Research. Joyce, great to have you on the program. What do you make of what we heard from Jay Powell? It was a very nuanced, but he gave a lot more guidance on what they're looking for. Will it make his job easier to achieve those targets?
Well, I think all eyes right now are on the fiscal discussions in the Congress, and that's what Jay Powell pointed to. And frankly, we're just seeing really little or no progress on the negotiations here, and you're running out of time. You know, the House is supposed to recess on October 2nd, the Senate on October 9th, but McConnell has said that he might send everybody home early, maybe the last week of September. So there is a real possibility that you don't see something done on the fiscal side. You know, the skinny bill, the $500 billion that was proposed by the Senate, they couldn't get the supermajority, the 60 to go through, and you didn't get a single Democrat to cross over. So I think there is immediate focus on this. I mean, in our forecast, we had been factoring in $1 to $1.5 trillion on that fiscal package. So you have a gap, and how much of this can get done by executive order, which Trump has already used. So that's one of the immediate questions. But then turning more to the Fed statements, I mean, I think they have very much telegraphed that this is something where the unemployment numbers, you know, are key here, and it's also, you know, multiple years, you know, before they will do the first formal review. I mean, they've said that that will probably be like 5 years before you do really even a review of this. So I think they have telegraphed this, and there is capacity in the Fed facilities which are not being fully utilized to do more. But you know, the forward guidance is the path that they, I think, want to go, and then using the existing facilities that they've already laid out if more needs to be done.
Joyce, given what Jay Powell was talking about the economy, does he has to deploy much more aggressive tools in order to ensure a recovery?
Well, I think, we saw the most synchronized and dramatic growth swing, up and down in history. And, what the market is focusing on right now is, is there a risk of a double dip? Is it early 2021? And what ammunition will be left at that point in time? I mean, cutting rates isn't much of an option given how low we are right now. So I think that, the Fed will continue to rely on the forward guidance, the QE measures they have in place. I still see, the possibility of the negative rates in the U.S. as being very low, and even yield curve control, something that they would not go to either. So I think you're going to see more of the type of messaging that we've seen. The focus by the marketplace is going to, it's on the fiscal package now. It will turn more to the elections, in the coming week. And then the question really is there a risk of a double dip that's out there that could mean more restructuring of the balance sheet?
Joyce, thrilled to have you with us. I'm loving that I'm starting my morning with Joyce Chang here. Joyce, this is going to be a 2-hour conversation, so make yourself comfortable. There's like 14 things to talk about, but let's go to aggregate demand right now. I'm sorry, all of this theory, monetary and frankly fiscal, is about nothing more than aggregate demand. Does Bruce Kasman think the demand's going to be there?
Well, I mean, for this quarter, you've had, considerable pent-up demand, and your goods spending really could overshoot here. So, the question, though, is this going to spark a turn in the business spending? Will you see a rebound in CapEx? And that's the part of the question that I think, the jury is really out in this. So you've had this historic surge. And, all 39 countries that we follow falling into recession, then this dramatic rebound and a surge in manufacturing and the goods sector activity that's underway right now. But whether that will actually result in a CapEx rebound, I think remains to be seen.
I mean, there's like 3 themes here with Joyce Chang, folks, and one of them is my essay of 2 summers ago, Jan Loy's talking about not the forecast, but just the model of a vector towards lower interest rates. Is that model still in place, Joyce Chang?
Well, now Jan and I have been updating really what this all means.
Well, update us.
And really saying that one of the casualties of all of this is going to be that traditional 60-40 asset allocation formula is one of the casualties of COVID-19. We've been looking at, for the last 45 years, if you did that traditional mix, you were getting about 10% return. We're looking at now, 3.5%. And whether you really will have to do more in the equity markets, and we're seeing, that play out this year, or some more of the hybrid fixed income that can give you more yield. So that vector very much did play out. Now we're talking about the consequences of that and what it means with respect to a traditional asset allocation formula that's been in place for 45 years and whether you're going to have to really see, a decided shift away from that.
Joyce, what will it take? There's a lot of correlations out there that we never used to have in the past. What will it take, for some of those bizarre correlations, frankly, to break?
Well, I think first of all that you just have what the developed market central banks have done is really sort of underpinning this. I mean, you've really blurred the line on capital allocation on many of the traditional things that we look at. So you would have to see, I think, a more marked shift away from policy. And if anything, the central banks are actually laying out frameworks that really extend this into the medium term. Now, that's still not going to solve the ultimate problem that we started talking about, is that do you see potential growth coming down further from here, and will we actually get that recovery in capex rebounding and business spending rebounding now that we've had sort of these V shapes all the way down and all the way up? And I think inflation is the other question that we're looking at. The inflation should mirror the growth volatility as good prices have been moving.
This is going to be fun. Joyce Chang with us for a nice part of this hour. I really want to point out on potential growth, her colleague Michael Ferroli way out front on a reduced potential GDP, that 3-4 years ago as well. This is fabulous. Joyce Chang of JP Morgan in this hour. In our next hour, a substantial conversation with Dr. Bremer on the American election. Also, Ian Bremer on the changed new map of international relations. This is Bloomberg. Good morning. Futures at -42. Bloomberg Surveillance. Good morning, everyone. Francine Lacroix and Tom Keene. Lots to talk about off the Fed meeting yesterday. We have a great conversation through the morning on that. On international relations, Ian Bremer with us in the next hour. Right now, Joyce Chang, to get your global Wall Street day started, if I can get my bow tie straight. There it is. And I want to talk to Joyce here. We're going to go all Latin on you right now. Francine's going to take notes because she's actually good at Latin. I'm not. And Joyce Chang, I want to talk about the dissents. Neil Kashkari yesterday, the Dove. And this is the idea of an ex-post or ex-ante Fed, a Fed that wants to get out front of the debate, or a Fed that wants to wait to see the inflation actually there. And Kashkari really took issue with the PhDs looking at the vector changing as a time to act, where he wants to wait to see inflation. Which will it ultimately be?
Well, look, I think that, core CPI inflation, we expect it to settle about half a percentage point lower as a result of the buildup in slack. And this persistent slack, all of this location, does have the potential to depress GDP growth, longer-term potential GDP growth. So I think, you're going to see inflation mirror the growth volatility, as good prices, have rebounded in the second half of the year. We saw some of that. But I think, the Fed messaging is very clear. The low core inflation poses a very significant challenge to all of the developed countries' central banks.
I don't mean to interrupt, Joyce, but this is so critical and goes to Lagarde and the Bundesbank as well. Do we have a new policy where we're not going to raise rates until there's the actuality of tangible inflation?
I think they are going to err more on that side because what COVID-19 has done is point to the credit easing policies in response to a sustained inflation undershoot. So that's where the messaging has been going for the last 6 months, and the framework target, the framework and the way that they've done the average inflation targeting really enforces that. So I do think that this is a major paradigm shift for what the central banks have been doing, and they stand prepared, and have laid out the benchmarks that they want to see more of a normalization, in the unemployment rates. And that normalization, what you're really facing here is, an incomplete recovery. I mean, we still think that relative to the pre-pandemic path, you're going to have global GDP that's about 4.3% lower than it was before the pandemic at the end of next year.
So, Joyce, what does it mean for other central banks? Who will adopt it first? The Bank of England has a whole other set of problems right now.
Yeah, no, I think that the Bank of England has a whole other set of problems, and then you have just the Brexit risk as well. And so, the question has been, are you going to see more upscaling of QE that needs to occur from the Bank of England and going to negative rates? I mean, that's really the debate that is going on right now. But I think all eyes are on Brexit right now after having a period where there wasn't a lot of focus on this. And, looking at the currency as well, there are heightened concerns that you really have a binary scenario in place. Will you get this bare bones free trade agreement, or could you have something that is much worse with respect to what the outcome is? I mean, the UK has sent this warning that the withdrawal treaty cannot be treated as sacrosanct if a trade deal is not forthcoming, and they also have a timeline now that they're getting closer to, and we see in the U.S. on the fiscal side that timeline actually is elapsing on the fiscal package that's under discussion now.
So, given what we know about the Bank of England and how you laid out Brexit, when would be an ideal time for Governor Bailey to actually put extra stimulus?
Well, I think that they're looking at the fall budget. That seems like it will have some tax increases in it. There also seems that it's been harder in the UK compared to some of the other countries in Europe in controlling the rise in the COVID-19 infection rates. And so I think that there's the Brexit timeline. There's the fall budget. There's also what happens with COVID, and as they get to this deadline, do you see both sides, coming to some type of accommodation where you will get, sort of a bare bones free trade agreement? I think a lot of focus is on the currency right now as well. Could you see further declines in spot if there isn't a deal? We still are looking at sterling, a real effective exchange rate that's still about 2% stronger than where it was post-referendum.
Joyce Chang, is the Phillips curve dead?
Well, I think that right now you have that just the persistent slack, and all of the dislocation you've had in the sectors is going to depress potential GDP growth, and that points to core CPI inflation, settling lower as a result of that buildup in slack. And you're not going to work through this, very quickly with respect to the hit to, global GDP growth. And I think you are looking at potential growth coming down here. We've already already, in our estimate on emerging markets, taken the potential growth forecast down by about 0.4% because we see China slowing from 6 to 4% by the end of the decade. So maybe it's not dead, but it is not going to be the near-term focus right now, given the bigger macro issues that we're discussing.
Well, this is Joyce Chang. Thank you so much. Really, really appreciate it as well. Joyce Chang will continue with us through this hour, and Ian Bremmer again with us later. As we drive forward on economics, on the U.S. economy with Barclays, Michael Gapin will join us. Look for that later today. Futures negative 37, the VIX up 1.60 points. This is Bloomberg.
We never thought COVID-19 is going to hit us, but now looking back, I don't know how we could cope without this new sector.
Hong Kong is not by itself a big market, but because of the growth GBA, there's huge opportunity. So we're seeing a huge wave of biotech innovation coming in the past few years.
Almost kind of certain that at the very beginning of our journey to pursue the biotech listings, we'll see a lot of the Chinese companies.
This is just the right thing to do at the right time, and it's such a big sector.
We have a second product for approval, and now are actively preparing for the commercialization. And we're expecting to have 2 more products to be approval before end of the year. So we have a high confidence that we will meet the expectation.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Kimmy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance. I'm Rishika Gupta with your Bloomberg Business Flash. It was a stock market debut to remember for Snowflake. Shares of the 8-year-old software company soared as much as 166% on their first day of trading. So at the close, Snowflake had a market cap of more than $70 billion. That makes it more valuable than Uber, Dell, and General Motors. In Europe, automakers hit a stumbling block on their road to recovery. They posted surprisingly weak sales last month. New car registrations plunged 18%. Government subsidies had helped European car sales recover in recent months, but some of those subsidies have now ended. And oil dropped below $40 a barrel in New York. The government reported a surprise decline in U.S. crude stockpiles. There's still concern that demand for oil won't be enough to push prices higher. And that is your latest Bloomberg Business Flash. Tom, Francine.
Ritika, thanks so much. Futures negative 36. There's a true weight to the tape today and correlated follow through. Remember, with the Dow went up 300 points off the Fed release yesterday and then settled back really down to flat off of the Powell comments in the presser. We go down further, a negative 254 points right now on the Dow, 27,683 at that level. Yields don't tell me anything. As Francine mentioned earlier, the dollar churning. Francine?
Yeah, I'm looking at European stocks. They're also suffering declines, Tom, across all industry groups. This is after, of course, that Jay Powell press conference, but also automakers really slumping after data showed that European car sales plunged by nearly a fifth in August. Now, coming up on Bloomberg Markets, William Danoff. He's Fidelity Investment Contra Fund Manager. We'll ask him about some of the correlations in the markets. That's coming up at 10 a.m. in New York. That's 3 p.m. in London. And this is Bloomberg.
Personally affected by the fire, direct family as well as extended members. We've had people who've had to evacuate themselves, and so it's kind of balancing out the management of our critical patients with just making sure that we can stay stable ourselves. This is just a lot for everyone.
Trying to reunite owners with their animals at this location. We're not sure exactly how long we will be here, and so we're attempting to make efforts to create some infrastructure and to make a more permanent temporary shelter that can serve the residents of Jackson County for the next couple of weeks if needed.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Tom, we're back with Joyce Chang of JP Morgan, where she's head of research. And Joyce was talking about the Fed. We were talking about some of the monetary policy also across the world, including the Bank of England. Joyce, what do you do with emerging markets right now?
Well, emerging markets, I think has been, a tale of two stories. I mean, the North Asian countries, very much led by China, are, recovering faster. But we are seeing, questions about really, are you facing a lost decade in Latin America, which has underperformed? There was mention of Turkey earlier. I mean, we're seeing, double-digit inflation there as you've had the FX pass-through to inflation. We've actually had to take the inflation forecast up there. We're talking about, where is there inflation? I mean, Turkey is one place where you can see that. So, you have a lot of variation depending on the region. North Asia is likely to outperform. That's led by China. We still have China at 2.5% growth, the only country that's really growing more positively. But Latin America is going to underperform here, and Turkey remains under pressure, and we are seeing that that's really coming out in the inflation numbers.
Are the Asian countries just that much stronger because they seem, Joyce, overall to have a better handling of COVID-19?
Well, I think it's also that you've had real surprising resilience in the export sector in China that was unexpected. And at first, that was in part because you had global demand for the medical supplies, for all of the PPE exports, for the personal protective equipment. But you've also then seen that translate into tech products. China was first in and it's first out. So some of the risks that we're going to be looking at is, how much will China slow, as the year progresses? It's being done at an enormous cost, though, I have to say. I mean, we estimate that this year you could have China's debt burden increase by 25 percentage points just this year. So I think that part of this is the management of COVID, but part of it is also that the manufacturing, the export numbers have been a lot stronger than expected, and you've got these big current account surplus right now in China as well.
Joyce, the great debate is when does international pop? It has lagged, and there's been bouts where international has done better. How do you advise JP Morgan Wealth Management on the when we will see a shift from U.S. domestic over to international investment?
Well, it has been winner takes all for the tech sector here, and we are estimating that big tech in the S&P 500 market cap now is about 45% of the market cap. And if you actually just spell that out in GDP terms, I mean, it's about 15% of global GDP. So you've had this K-shaped recovery, with the sort of tech winner takes all, and we've actually taken the S&P target up to 3,600 here. And part of that is because you've had the companies here have really been able to create a liquidity buffer and build up cash balances. We're actually back to $2 trillion where we were before the Tax Act on the cash balances. And we've had to take up also on the U.S. high-grade corporate bond market, the forecast on capital raising. We had it at $1.6 trillion, an all-time record. We took it up to $1.75 trillion of issuance. And usually the month of August is dead quiet. It was very active in capital market activity. So what you are seeing is that companies have been able to use this window to shore up the cash balances here, bring them back to where they were, but you're seeing it very much concentrated in one sector. So it still has been winner takes all for the tech sector. That's been the story this year, and it could very well continue for the remainder of the year.
Do you see consolidation? If we can't find growth, if we're in subdued GDP, I'm still not used to the idea of Joyce Chang telling me a China GDP under 3%. Is just a simple path across all of your equity analysis that we will see combinations?
Well, I think that what we're really looking at is what is your risk of a double dip? So record second quarter down, record third quarter up. what does the fourth quarter hold? And then how are we going to see some of these geopolitical risks, such as Brexit, the U.S. elections play out, which will just give us more of a sign on whether, a double dip is a possibility that you have to give more attention to, rather than the numbers that are printing this quarter. And I think that, market participants are going to look for continuing stability in the credit markets, and they are going to expect that central banks play a role in that, in ensuring accommodation that aligns with that type of stability. So the risk of a double dip is what we're really focused on as we head towards the end of the year, because we do keep on emphasizing this is an incomplete recovery. Even though we've had these big synchronized growth swings, there are huge gaps in some of the regional performance. And you can see that in emerging markets in particular. But relative to the pre-crisis path, we still see potential growth, coming down. That you're well below a bigger hit than what the global financial crisis was on global GDP.
Great, thank you so much. Joyce Chang, their JP Morgan Chair of Global Research, staying with us. Now let's get straight to the Bloomberg First Word News in New York City is Ritika Gupta. Hi, Ritika.
Hi, Francine. Tom, President Trump says one of his top officials is wrong when it comes to the coronavirus vaccine. CDC Director Robert Redfield predicted the vaccine will be distributed in late spring or early summer next year. Trump disagrees. He says the shot will be available as early as October. President Trump is moving closer to a bipartisan plan for more stimulus spending. The president said he liked the compromise $1.5 trillion proposal from a bipartisan group of House members. He urged Senate Republicans to, quote, go for the higher numbers. There's been a months-long deadlock over the coronavirus relief bill. And British Prime Minister Boris Johnson has made a key concession on his controversial Brexit law-breaking plan. He agreed to give the House of Commons veto power over whether his government can override parts of the Brexit divorce treaty. Members of his own Conservative Party have threatened to rebel against Johnson. Which is harder to solve now, the coronavirus pandemic or climate change? Bloomberg's Eric Schatzker put the question to billionaire philanthropist Bill Gates.
Climate change is much harder, and the damage that will be done every year will be greater than what we've seen during this pandemic. So, I hope it's a wake-up call to think, okay, what else are we being warned about? Does it take, what percentage of government resources would that take? And, holding people to account that even things that take a long time,
Okay, ladies and gentlemen, new order placed to buy euro at 1.1788. I'm placing a new order to buy euro against United States dollar at 1.1788. Okay.
To Bloomberg Green Festival, the week-long event gathers thinkers, scientists, and business practitioners for a virtual event focusing on core issues of climate change. Well, today includes Bill and Melinda Gates Foundation co-chair Bill Gates and World Green Building Council Chief Executive Christina Gamboa. That starts 8 a.m. in New York, 1 p.m. in London, and this is Bloomberg.
On the European Union, I would want to say that I refuse to paper over this migration challenge. This is a common European challenge. I'm convinced, with strong proposals made by the Commission, that we need to tackle seriously this challenge, and it's why I am here, first of all, in order to express my solidarity.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, a cloud data software maker, Snowflake, saw a euphoric stock market debut that transformed the 8-year-old company into a business now more valuable than Uber, Dell, and General Motors, Tom. It's a $3.4 billion IPO, and it's the biggest in the U.S. this year. It sets a record for software deals. Snowflake Chairman and Chief Executive Frank Slootman spoke with Bloomberg's Emily Chang about the debut.
We're thrilled with the reception. We really started assembling our institutional ownership, a little bit over a year ago. So this is really not something of the last couple of weeks. And we had people, buy into a tender offer we did earlier, January, February timeframe. So Snowflake is really a heavily vetted company. So by the time we got to the IPO, there was really high conviction into buying into the offering. So we're thrilled with the way things have gone this week.
So talk about conviction. Shares more than doubling. You priced at $120 a share, closed at $253. That said, you left a lot of money on the table. I mean, do you have any concerns that you've given the bankers a little too much here?
Well, the assumption is always that, we could have sold the entire offering at the number that we closed at. And obviously, there's such a thing as a demand curve. There's always investors that are, willing to, buy some number of shares at higher prices. But, as you know, the IPO is a price discovery process, and we were after a very specific set of institutional investors, people that can hold multi-billion-dollar positions that are willing to hold down for 5 to 10 years, and also people that don't chase momentum either up or down. So that's really how we landed at our price. It's not unusual for a price to get chased up by momentum players in retail and so on. So there's a lot of noise to it. So the idea that we could have sold the whole thing at the price that we closed at, I don't think is reasonable. So.
That said, is there a lesson here for some of the other companies looking to go out of the gate? We've got huge public debuts expected for, some other huge companies in Silicon Valley, Airbnb, Palantir. Any advice?
It's hard for people to price a high growth asset because, high growth asset is how fast is it going to grow into its valuation, right? So you need to really do a lot of work with investors. Because they have to make a long-term bet, right? This is not a 12-month deal. People are buying in for 3, 5, 7 years, and they need to understand the story extremely well to be able to do that and have the conviction. I mean, one of the reasons, why the stock ran up and we were really delayed in trading is because we just had no sellers. People were just hanging on for dear life. So that sort of slowed things down a bit today.
Now, investors are seeing an opportunity here to disrupt Amazon because what you offer, it's basically your own version of a data warehouse. Amazon does have a similar product. What do you have on them?
Well, what we have on the whole industry is really a product that was built from the ground up, clean sheet of paper, by a group of people who were some of the world's greatest database technology architects, people that really understand the technology really well. Also, what it was lacking all this time. And, when it gets completely redesigned, reimagined for cloud scale computing, you end up with a completely different product architecturally and something that innovates on multiple vectors at once. And you compare that to what other people are offering out there. They're all trying to carry legacy architectures, software designed for machine computing to the cloud, and they find out that they really can't take advantage of cloud scale, and that's sort of what you see going on. I mean, Snowflake is a deceptive product because it's incredibly powerful given the underlying platform, which is the public cloud. We only run on a public cloud, and we have zero legacy in terms of older machine architectures.
Mr. Slootman of Erasmus University in the Netherlands. This is an extraordinary story, and I don't need to go into the IPO. Pharaoh got his 8,000 shares as usual. I got nothing. With us, Joyce Chang of JP Morgan. Joyce, I want to go to you on Silicon Valley. And full disclosure, folks, JP Morgan, I think, has provided real leadership here on the manipulated scarcity when somebody goes public. We've seen this for ages in Silicon Valley. Are these legit processed initial public offerings, or is it nothing more than the manipulation of arch scarcity by private owners?
I think that you've got just broader dynamics that are in play here. And the first thing I would just say is that in this zero yield world, you now have that safe assets, your developed government bond market debt. You're looking at about 70% of this debt having a yield that is less than 50 basis points. You're looking at fixed income indexes that have a yield that's only 1%. So you've had just this demand that is really being put into place structurally because of what's been happening, in the bond market. And that's really the first overriding macro point that I would make about this. And then you've had that, everybody sees that in the tech sector, every day has made their lives easier. I mean, you kind of had perfect conditions during this pandemic to help the tech sector, that you've had to have all of your education, your social activities, and your work activities occur online and using all of these new tools. So I don't know if I would talk so much about the specifics of the transaction than the structural shifts, and that in the equity markets we still are seeing that the flows are not saturated yet. That there is still that if you look at year-to-date flows, you're still in negative territory. So there's still space here, and this is one reason why we've been comfortable taking up the target for the S&P 500.
Joyce, when you look at some of, I guess, part and parcel with the furlough schemes ending across the world, do you worry that there's going to be many bankruptcies of healthy companies? And if yes, what will replace them?
Well, we're actually looking at the default rate, that the openness of the capital market has brought a lot of space to larger companies. We've had that U.S. companies have accessed the capital markets at an all-time record pace, and they've built up cash reserves. So even looking at the default rates, like in the U.S. high-yield market, we are looking at a default rate of 8%. We think that it's going to come in below that. So the openness of the capital markets has helped in the larger corporate sector. I think you are going to see more questions on what happens with small businesses and what happens at that level. Now, the Fed facilities, they have not had to use that much. I think the amazing thing is that you've had the markets come back, both in spreads and in the record issuance, with only using about $12 billion. So it has been more just getting those markets to reopen that has provided companies with a way in which they've been able to really build up their cash reserves here.
Joyce, this has been wonderful. Very generous of you to be with us for this length of time. Joyce
great to be with you both.
is Chair of Global Research at JP Morgan. And this, after I really want to emphasize this, folks, I don't think it got enough play yesterday. An absolute original Fed meeting yesterday. New York Fashion Week, there's one person I want to talk to, Robert Burke, but he tops it later this morning. Rebecca Minkoff on Francine's Next Bag. This is Bloomberg.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. I'm Francine Lacqua in London, Tom Keane in New York. Tom, the Prime Minister Boris Johnson faces a battle in the House of Lords over his controversial plan to break international law over Brexit. Now, the former Tory leader, Michael Howard, weighed in on Johnson's fight in an interview with Bloomberg's Anna Edwards.
My objection to this bill is that it invites Parliament to use its sovereignty. Parliament is undoubtedly sovereign in the United Kingdom, but it invites Parliament to use its sovereignty to break international law. And I don't think Parliament should be asked to do that. I don't think the government should have asked Parliament to do that. So the only thing that would satisfy me, as far as I can see at the moment, is if the government were to withdraw from the bill those parts of it which would breach international law. Not all the bill is against international law, but some parts of it are.
Do you think that that is a view that is shared by some in the House of Commons in your party who have said that they will not vote for the bill?
I really have no idea. I mean, it sounds, from what I heard last night on the media, as though a number of those who had previously said they were unhappy are now content. Whether there are some of them who agree with me, I just don't know.
There was a mechanism written into the withdrawal agreement for solving differences that maybe had not already been solved through the earlier parts of negotiation, the joint committee. Do you know why the government has not gone down the route of trying to use that to resolve these tensions?
No, I don't, and you've put your finger on it. My whole argument is that those processes have to be used. In fact, there's an article in that withdrawal agreement which commits both the UK and the EU only to using those procedures to resolve any disputes. It's Article 168. And that's what I think the government should be doing. If it can't reach agreement in the Joint Committee, then the procedure set out in the withdrawal agreement is to go to independent arbitration. That's what the government should be doing, not threatening to break the law.
Why do you think the government has chosen this path, Michael? Do you think it likes the heat that this creates?
I'm afraid you'll have to ask the government that question. I'm not able to see into Boris Johnson's mind.
Okay. What about the response that this bill will get if it does get to the House of Lords? So if the Commons passes it, what will be the approach that will be taken in the House of Lords, do you think? I mean, will you try to stop it? Will it be deemed to have been in the manifesto or not at all, and therefore the Lords will try to stop what the government is trying to do here?
No, the manifesto was the election and the manifesto were on the basis of this withdrawal agreement. The election was in December last year. This withdrawal agreement was in October. So the government was fighting the election on the basis of this withdrawal agreement. I think the bill will have a really rough passage in the House of Lords. It may be that the last night's concession will satisfy some of my fellow Conservatives, but the Conservative Party doesn't have a majority in the House of Lords. I think virtually every peer who isn't a Conservative will probably vote against it, and quite a few Conservatives, including myself.
The gentleman from Wales, Lord Howard, that was wonderful. Francine Lacqua, I think a lesson's in order here. The Lords really takes a different approach than the green-leathered House of Commons, don't they?
Well, the House of Commons, of course, is political because you're appointed by your party.
Yeah,
so
yeah,
some say, you know, even if you don't want to vote for or against a law, actually you may be coerced into it. The House of Lords, Tommy, it's a different tone. You're meant to be apolitical, but also they see themselves as the guardians of the Constitution, which is why we could see a very different tone and a very different vote.
Well, we will continue. Tom Keene in New York, Baroness Lacroix in London, and we have an interesting hour coming up as well. Futures negative 36, a real weight to the tape, a genuine weight to the tape off the Fed meeting. This, I really want to underscore, you're looking at a 500-point move from the enthusiasm of the statement up 300 Dow points down to flat, and now futures negative 252 on the Dow. It's been a 500-point waltz from the moment of the statement release yesterday. Most interesting as well. Dollar flat, yen 104.74, I think bears notice here. Euro weaker, yen stronger as well. Coming up in the next hours, we spoke to Joyce Chang of JP Morgan in the last hour. Ian Bremmer will join us from Eurasia Group. And yes, I got an email yesterday. We're starting to work on our New Year's show. Dr. Bremmer, the next hour. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Some things you see coming. Some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
This morning, a weight to the tape, Chairman Powell, he weighs in on the path to January 2024. The Fed forecasts a 2023, well, it's, morning in America. In this 2020, retail sales suggest a weaker economy. Surveillance breaks elusive, Powell and Trump. Trump and Powell on the same page. Fiscal support, it's needed now. And the doctor is in, Dr. Redfield, by way of Georgetown Medical, Walter Reed, Columbia University, and the University of Maryland. He suggests a vaccine summer of next year. Dr. Trump begs to disagree. Good morning, everyone. This is Bloomberg Surveillance from New York, in London as well. Francine Lacroix. Francine, I thought Lord Howard was fascinating there about this division of the Lords and the Commons in the UK. I mean, we have the House and the Senate, and it's ugly. Does the Lords have a lot of power to actually change the political debate of Brexit?
Well, they do in this case, Tom. So if we just take it back a couple of weeks, it's the first time we had heard, although there were mentions, especially by Michael Gove, right before Boris Johnson signed the deal with the EU, that they would break international law. Now, let's go back. Basically, there's this withdrawal agreement between the UK and the EU. Yeah. And now Boris Johnson says, well, we don't have to abide by that when it comes to dealing with Northern Ireland. The House of Commons said, yeah, that's fine. We can break international law. And we heard from Michael Howard speaking to our Anna Edwards saying, look, there are a lot of Tory rebellion regarding this because it's unfair to ask Parliament to break the law. And, you know, the House of Lords could either delay the bill by a year or flatly reject it because they see themselves as, you know, the upholders of the Constitution. Your constitutional lesson for the day with Francine Lacroix. Let's go forward here with futures negative 33. Our first word news in New York City. Here's Ritika Gupta.
Morning, Tom. Francine. President Trump has slapped down some of his top health officials. He contradicted them at a news conference, saying that a coronavirus vaccine could be distributed widely to the public by as early as next month. CDC Director Robert Redfield told Congress that the vaccine would be distributed in the second and the third quarter of next year. The president called those comments a mistake. At least one person was killed and hundreds were rescued after Hurricane Sally came ashore near the Florida-Alabama line. Heavy rain